U.S. stocks exploded to multi-year highs, with the Dow closing at a record for the first time in 2025 after months of gains powered by tech, AI, and strong earnings. The Trump-Putin summit captured global attention as leaders met amid pressure to resolve ongoing geopolitical risks that are affecting you and your holdings in the market. And Fed Chairman Jerome Powell's much-anticipated Jackson Hole speech ignited Friday's rally, opened the door to a possible September rate cut and maybe more, and that just was the beginning of what I think is going to be a rally into the end of the year. Stay with us. The CB3 Financial Weekly Update starts now. Folks, it's been an extraordinary year for U.S. equities. The Dow, S&P, and NASDAQ have all chalked up all-time highs in August. After a brief pullback mid-month, Friday delivered the latest spark. The Dow soared 846 points, or almost 2%. Actually, it was up over 1,000 points at one point, very short period of time. But that's its first record close in 2025 at 45,632, while the S&P jumped 1.5% and the NASDAQ leaped nearly 2%. So much of this fuel comes from a mix of factors. Let's go through those. Megacap, tech, and AI leaders like NVIDIA, Amazon, Alphabet, which is Google, have blown away earnings estimates, leading the charge in both growth and sentiment. Even Apple has joined with a big move up last week, not so much this week, but last week. So the Magnificent Seven is doing their part again to drag the rest of the market higher. Small caps, banks, and cyclicals have joined the party, with the Russell 2000 index surging nearly 4% on Friday. And I'm glad we have some small cap holdings in CG, and it reflects the renewed market breadth and risk appetite. So we've known there has been risk appetite in the market, but it hasn't been very far and wide. It hasn't had what we call breadth. But now we're starting to see that, and I've said this for years. If you want to see a secular bull market continue, you have to have breadth. You have to have all 11 sectors participating. Even the defensive sectors have to be participating somewhat, and all asset classes. So the S&P, the NASDAQ, the Dow, and the Russell all need to be moving higher. So despite worries earlier in the summer, a more optimistic trade outlook and continued consumer resilience have kept the stock market engine running. Market momentum has broadened, but yet some analysts are warning that the leadership is narrow. I'm not seeing that narrow leadership like I did earlier this year before that downturn in April. Big tech still dominates, but it's going to do that when you have 5 companies in the Mag 7 that represent 25% of the entire S&P 500. So we're all going to keep an eye out for the signs that the rally is becoming more inclusive as more sectors participate. That's what we want to see. We are looking for some more octane for our GI program. We'll be adding 4 new stocks tomorrow morning, and we expect to see that participate more fully in this rally. We had to do this in 2022 when the market took off later in the year, and we needed that additional octane in what is traditionally our most conservative program. So the Trump-Putin meeting, well, that's geopolitics taking center stage. This week, all eyes were on the Trump-Putin summit in Alaska, a rare, really rare face-to-face meeting in a tense international environment. The meeting was closely watched for signs of movement on the Ukraine front and global trade relations, but folks, there was simply no big breakthroughs. And I think Donald Trump had a really long flight home to the White House, and I don't think he was the least bit happy. If nothing happens in the next 30 days, you will see crippling banking tariffs happen and all kinds of systems where they can shut down the flow of money from other nations into Russia, and it could cripple his people. The problem is he doesn't care. He has enough money that he can keep paying his army, which is how he stays in power and how he stays protected. But for the markets, the headline risk was real. A constructive tone kept market nerves steady and limited the chances of any major sell-off, but investors will keep watching for any real policy shift or sanctions. Energy, defense, and the currency markets all reacted, but the big story for stocks was simply that the summit passed without sparking chaos, and that's good news for risk assets heading into September. As you know from listening to me for the last 15 years, September is the worst month of the year. 50% of the time, it's mediocre, and about 50% of the time, it's down. So since 1955, most of the time it has been negative. You have to go back many, many years to get any kind of positive response in September. So what happened? Jay Powell's speech was a hit in that the fireworks came courtesy of his speech. At about the halfway point in the speech, you could see the market starting to inch higher because people were starting to think, okay, he's finally going to relent and cut a quarter point, maybe even 50 basis points at the September meeting. So he acknowledged persistent inflation, but for the first time, he moved the needle towards a likely rate cut. Investors cheered Powell's remarks on a changing balance of risk as signs of softening labor markets gave the Fed more flexibility to cut. So it really helps when you see weakness in the economy because that means that inflation is not likely to get exacerbated. Treasury yields dropped, the dollar weakened, and stocks soared. All classic signals that Wall Street believes easier Fed policy is imminent, meaning September, then October, then December. Sectors like consumer discretionary, energy, communication services, and tech led the charge. Those are the four big aggressive sectors that we watch really carefully. And major stocks like Amazon, Alphabet, Google, again, Meta, and Tesla all were up and had a big day. So looking ahead, going forward, attention will stay fixed on the Fed's next move. We've got to see that rate cut in September, just have to. And a 50 basis point move would really go a lot towards saying to the market, hey, we are done as far as even a chance of any rate hikes or keeping this thing even. We are starting to edge back down to lower rates. With earnings still robust, especially in tech, and financial conditions easing, the stage is set for these continued gains if the Fed delivers. What are the key risks? Renewed volatility if the rate cut hopes get dashed or any turbulence from international headlines. But for now, momentum remains strong, and with new highs across the board, investors are feeling the summer tailwind. Stay with us. We'll be here Labor Day weekend to give you an update. Hope that you have a great week ahead and a great Labor Day weekend planned. The summer is ending. We're moving into autumn. September's a volatile month, but October, November, and December are traditionally the strongest months of the year. Thanks for listening. I'm Charles Brown. This is the CB3 Financial Weekly Update. We will see you next time.